War is supposed to be bad for everything. It destroys cities, closes businesses, interrupts trade, forces families from their homes, and consumes enormous amounts of money that could have been spent building schools, hospitals, roads, and factories. So when a war begins and the stock market suddenly rises, the reaction can feel almost disturbing. People are losing their lives, governments are preparing for disaster, and television screens are filled with explosions. Yet somewhere else, traders are buying stocks. Charts are turning green. Headlines are announcing that the market has gained hundreds of points. How can both things happen at the same time? Does the market somehow benefit from war? Are investors celebrating destruction? Or is the stock market seeing something that ordinary people cannot? The answer begins with one uncomfortable truth. The stock market is not a measure of whether the world is becoming better or worse. It is not a happiness meter. It is not a morality meter. And it is certainly not a measurement of human suffering. The market is a giant machine for pricing expectations. Every day, millions of investors are trying to estimate how much money companies will earn in the future, how expensive borrowing will become, what governments will do next, and how much risk they are willing to accept. That means stock prices do not respond only to what is happening now. They respond to what investors expected to happen before now. And sometimes, the fear before war can become worse than the reality after it begins. Imagine two countries moving closer to conflict. At first, there are only rumors. Military vehicles are seen near a border. Politicians begin making threats. Embassies tell citizens to leave. Airlines cancel flights. Governments hold emergency meetings. Nobody knows what will happen. Will there be a small confrontation, a full invasion, a regional war? Will larger countries become involved? Will oil supplies be interrupted? Will shipping routes close? Will cyber attacks hit banks and power grids? Will the fighting last for days, months, or years? Investors do not have answers. And markets hate unanswered questions. A company can plan for high costs. It can plan for low demand. It can even plan for a recession. What is much harder to plan for is a situation where nobody knows which version of the future is coming. During that uncertain period, investors begin imagining every possible disaster at once. They imagine oil prices exploding. They imagine global trade slowing down. They imagine inflation returning. They imagine interest rates rising. They imagine consumers becoming afraid to spend. They imagine governments entering the conflict. They imagine a much larger war. One investor sells because they fear higher energy prices. Another sells because they fear a recession. Another sells because they think other investors will sell. Soon, fear begins feeding on itself. Stock prices fall before the first shot has even been fired. Then the war actually begins. The event everyone feared is now real. That sounds like the moment stocks should collapse even further. But sometimes the opposite happens. Once the conflict begins, investors finally receive information. They can see which countries are involved. They can see whether the war is spreading. They can see whether oil is still moving. They can see whether major shipping routes remain open. They can see how governments are responding. They can begin estimating the economic damage. The situation may still be terrible, but it is no longer completely unknown. Instead of facing 100 possible disasters, investors may now be facing 5. And if the actual conflict looks less catastrophic than the worst scenarios already reflected in stock prices, the market can rise. This is often called a relief rally. The word relief does not mean investors are happy that the war happened. It means they are relieved that the situation is not as bad as they had prepared for. Suppose the market believed there was a serious chance that 5 countries would enter a conflict. Stocks fall sharply. Then fighting begins, but it remains limited to 2 countries. That is still a tragedy. But from the market's perspective, one of the worst possible outcomes has become less likely. So prices recover. The market is not asking, is war good? It is asking, is this outcome better or worse than the outcome we had already priced in? That distinction explains much of what appears irrational about financial markets. A company can report terrible earnings and see its stock rise because investors expected something even worse. Another company can report record profits and see its stock fall because investors expected the record to be larger. Markets do not react to whether news is good or bad in isolation. They react to the distance between reality and expectation. War follows the same rule. If investors expected total disaster and received limited disaster, prices may rise. If they expected a short conflict and received a long one, prices may fall. The surprise matters more than the headline. There is another important reason markets can rise during war. The stock market is not the entire economy. When people hear that the market went up, they often imagine that every business and every person must be doing well. But a stock index usually represents a selected group of large companies. Some of those companies earn money across dozens of countries. Some sell products that people continue using during almost any crisis. People still need food. They still need medicine. They still need electricity. They still need communication networks. Companies still need software, cloud services, cybersecurity, transportation, and banking. A conflict may destroy local businesses in the affected region while having a much smaller effect on a global company earning revenue elsewhere. The economic pain can be severe without being distributed equally. A hotel near a conflict zone may lose all its customers. An airline may face higher fuel costs. A local factory may be forced to close. But a large technology company with customers around the world may continue collecting subscription payments every month. A pharmaceutical company may continue selling medicine. An energy producer may earn more because oil and gas prices have increased. A defense company may receive new government contracts. All of those businesses may appear inside the same stock index. So the index can rise even while millions of people are facing hardship. This becomes even more confusing because large companies do not all have equal influence. In many major indexes, the biggest corporations have the greatest effect on the final number. If a small group of enormous companies rises, it can pull the entire index upward, even when most other stocks are falling. The headline might say, "The market gained today." But beneath that headline, airlines may be down, travel companies may be down, retailers may be down, manufacturers may be down, small businesses may be struggling. A few giant companies can hide a great deal of weakness. This is why one number rarely tells the full story. War also creates winners and losers across different industries. Defense companies are the most obvious example. When governments feel threatened, they increase military spending. They order aircraft, vehicles, missiles, surveillance systems, protective equipment, communication technology, and ammunition. Existing stockpiles need to be replaced. Factories receive new contracts. Suppliers hire more workers. Investors expect higher revenue, so defense stocks may rise. But even here, the story is more complicated than it first appears. When a weapons manufacturer sells equipment, the company records revenue. Its shareholders may benefit, but society has not necessarily become richer. If that equipment is used to destroy a bridge, a home, or a power station, one company has earned money while the world has lost something valuable. The sale appears in corporate earnings. The destruction does not appear as a negative number in the same company's financial report. This creates the illusion that war can produce prosperity. It can produce spending. It can produce revenue. It can produce jobs in certain industries. But spending is not the same thing as creating wealth. Imagine a town builds a beautiful hospital. It took years of labor, concrete, steel, technology, and planning. Now imagine, the hospital is destroyed. The government later pays another company to rebuild it. Construction activity rises. Workers are hired. Money moves through the economy. Official statistics may show more spending, but the town is not richer than before. It is spending enormous resources simply to return to where it already was. War can increase economic activity while reducing real wealth. That difference is crucial. Energy companies may also benefit during conflict. If a war threatens an oil-producing region or an important shipping route, energy prices can rise quickly. Oil and gas producers may suddenly earn more money for the same amount of production. Their costs may not increase as fast as the prices they charge. Profits rise. Investors buy the stocks. The energy sector strengthens even as households pay more for fuel, transportation, heating, and electricity. Again, what is good for one group can be painful for another. Higher oil prices may help an energy producer, but they hurt airlines. They hurt delivery companies. They hurt factories that use large amounts of energy. They hurt families who must spend more to drive to work. They make food more expensive because farms and trucks require fuel. A stock market can contain all these businesses at once. The final movement depends on which companies are largest, which effects investors believe will last, and which expectations were already included in prices. Cybersecurity companies can experience a similar effect. Modern conflicts do not happen only on battlefields. Governments, banks, hospitals, communication networks, and power systems may face digital attacks. Companies become afraid of disruption. They increase security spending. Cybersecurity firms receive more contracts. Their stocks may rise because investors expect years of increased demand. Satellite companies, drone manufacturers, logistics firms, and communication providers may also attract attention. War rearranges spending. Money that once went toward consumer projects, infrastructure, or social programs may be redirected toward security. Some companies lose business. Others receive more than they can handle. Governments play an enormous role in this process. During peace, investors worry about government deficits and debt. During war, those concerns may temporarily become less important than survival. Governments borrow huge amounts of money. They increase military budgets. They support important industries. They protect banks. They subsidize energy. They provide emergency aid. They may guarantee loans or directly purchase goods and services from private companies. This flood of government spending can support corporate revenue. A factory that was losing orders may suddenly receive a large contract. A transport company may be paid to move equipment. A technology company may be hired to build secure systems. A construction company may be asked to strengthen infrastructure. The private economy receives money from the public sector. Investors begin calculating which companies will benefit. But the bill does not disappear. Government spending must eventually be financed through taxes, borrowing, inflation, or some combination of all three. In the short term, markets may focus on the money entering corporate accounts. In the long term, society must deal with the debt. This is another reason stock prices can rise while ordinary people feel that conditions are getting worse. The market may see higher company revenue. Households may see higher taxes and higher prices. Both can be true. Central banks can influence the reaction as well. During a severe crisis, financial authorities often try to prevent panic from destroying the banking system. They may provide emergency funding. They may support credit markets. They may delay interest rate increases. In some cases, investors may expect rates to fall because the economy is weakening. Lower interest rates can make stocks more attractive. When safe investments pay less, investors may accept more risk in search of higher returns. Lower rates also reduce borrowing costs for companies. Future profits become more valuable when they are discounted at a lower rate. So a strange chain of events can occur. War increases economic fear. Fear raises the chance of government support. Government support raises the chance of easier financial conditions. Easier financial conditions make investors more willing to buy stocks. The market rises because people expect authorities to respond to the crisis. This does not happen in every conflict. If war causes severe inflation, central banks may be forced to raise rates instead. But the possibility of intervention often changes investor behavior. Markets have learned that governments and central banks do not like financial systems collapsing during emergencies. That expectation can create confidence even before support is officially announced. There's also a powerful emotional cycle at work. Before a war, investors experience fear. During the early stages, fear can become exhaustion. People have already sold. Funds have already reduced risk. News outlets have already discussed the worst possibilities repeatedly. By the time the event finally occurs, there may be fewer nervous investors left to sell. This is sometimes described by the phrase, sell the rumor, buy the news. The idea is simple. People sell while they are afraid of what might happen. Then, when the feared event actually happens, some of them buy back because the uncertainty is over. The event can be terrible and still produce a rally because financial positioning had become extremely negative beforehand. Imagine a crowded room where everyone believes there may be a fire. People rush toward the exit before they see any smoke. Then someone discovers that the danger is limited to one small area. The building is not safe, but it is not completely burning down. Some people return. The stock market often behaves in a similar way. Prices are shaped not only by events, but by how investors were positioned before those events. If everyone has already sold, even slightly positive news can create a large increase. There is another reason stocks may turn upward while the economy remains weak. Markets are forward-looking. Economic reports describe the past. When a government announces last quarter's unemployment rate, investors are already trying to estimate next year's recovery. When a company reports that sales fell last month, traders are asking whether sales will rise 6 months from now. The market attempts to move before the economy changes. That is why stocks can rise during recessions. Investors do not wait until every factory reopens and every worker is rehired. They buy when they believe the decline is approaching its end. War can create the same pattern. The fighting may still be happening. Economic damage may still be increasing. But if investors believe negotiations are becoming more likely, supply routes are stabilizing, or governments will eventually begin reconstruction, they may buy early. By the time peace officially arrives, the market may have already recovered. This can seem cruel because financial markets often move on hope while real people are still suffering from the present. But investors are not buying today's economy. They are buying a claim on future profits. That future can improve before present conditions do. Reconstruction can become part of that expectation. After a conflict, damaged roads, bridges, homes, factories, power stations, ports, and communication networks must be rebuilt. Construction companies may receive contracts. Steel and cement demand may increase. Engineering firms may be hired. Banks may finance new projects. Governments and international organizations may provide assistance. Investors begin anticipating this activity long before rebuilding begins. The possibility of peace can push certain stocks higher even while destruction continues. But once again, reconstruction should not be confused with free prosperity. Replacing something that was destroyed does not erase the loss. If a family loses its home and later builds another one, economic spending has occurred twice, but the family has not received 2 homes. It lost one and paid to replace it. Markets may benefit from the spending without measuring the pain that made the spending necessary. Currency movements can also affect stock prices during war. When conflict weakens a country's currency, companies that earn money abroad may appear more profitable when those foreign earnings are converted back into the local currency. Suppose a company sells products in several countries. Its home currency falls. The same foreign revenue now converts into a larger number of local currency units. The company's reported earnings may rise even if it sold exactly the same number of products. Investors may buy the stock. Meanwhile, citizens of that country become poorer because imported food, fuel, medicine, and technology cost more. A weak currency can help exporters and hurt consumers at the same time. This is another example of the market rising while living standards fall. Inflation creates even more confusion. Companies report revenue in money, not in purchasing power. If prices increase by 20%, a business may earn 20% more revenue without selling more products. The number looks larger, but the real value of the business may not have improved. Some companies can raise prices faster than their costs. They protect their profits. Others cannot. Businesses selling essential goods often have more pricing power. People may delay buying a new television, but they cannot easily stop buying food, medicine, or electricity. Investors move toward companies believed to be protected from inflation. Those stocks rise. The broader population may feel poorer, even as corporate revenue reaches record levels. This helps explain why economic statistics and personal experience can tell completely different stories. A stock chart may rise because nominal profits increased. A household may struggle because the cost of surviving increased even faster. War also changes where investors place their money. When fear rises, many investors search for assets they consider safer. They may buy government bonds, gold, cash, or currencies associated with stable economies. This movement can push stock prices down. But once the initial panic passes, investors may decide that stocks have become too cheap. They return, especially if they believe governments will protect the financial system. The movement from fear to opportunity can happen very quickly. A market that looked uninvestable on Monday can appear attractive on Friday. Nothing about the human tragedy needs to improve. Only the financial calculation needs to change. Professional investors are often judged against other investors. A fund manager who remains in cash while the market rises may lose clients. So even if they personally believe the world is dangerous, they may feel forced to buy. They are not only asking whether stocks are safe, they are asking whether everyone else is about to buy before they do. This creates a race. Once markets begin recovering, fear of loss is replaced by fear of missing out. Investors who sold during the panic rush back in. Their buying pushes prices higher. The rising prices convince more people that the danger has passed. More money enters. A relief rally becomes a momentum rally. The market may rise far more than the original news justified, simply because investors are chasing one another. But none of this means war always causes stocks to rise. Some conflicts create damage too severe for markets to ignore. A major energy shock can make almost everything more expensive. A conflict involving important trading nations can disrupt global supply chains. A war that spreads across several regions can reduce business investment for years. Governments may accumulate dangerous levels of debt. Inflation may force central banks to raise interest rates. Consumers may lose confidence. Companies may lose access to materials, workers, financing, and customers. In those situations, the market can fall for a long time. The outcome depends on several questions. Where is the conflict happening? Which countries are involved? How long might it continue? Are important commodities affected? Can trade continue? Will other governments intervene? How much damage was already expected? And which companies dominate the stock index being measured? A war taking place inside a country's own cities will affect its market differently from a distant war that increases demand for its exports. A country that imports nearly all its energy may suffer from higher oil prices. A country that exports oil may benefit. A nation with strong finances may be able to support its economy. A heavily indebted nation may have fewer options. There is no universal rule saying war makes markets rise. The real rule is that markets respond to changes in expectations. Sometimes war is worse than expected. Sometimes it is less bad than expected. Sometimes one part of the market rises while another collapses. And sometimes the index gives such a simplified picture that it hides what is actually happening. Historical patterns can also mislead investors. People may look at a previous conflict, notice that stocks recovered, and assume the next war will produce the same result. But every conflict is different. Technology changes, economies change, alliances change, energy dependence changes, debt levels change. A war in one decade may remain geographically limited. A similar conflict in another decade may spread through cyber attacks, sanctions, financial markets, and global supply chains. The fact that stocks recovered after one war does not guarantee they will recover quickly after another. Markets remember patterns, but history rarely repeats perfectly. It usually changes the details. There's also a moral danger in discussing war only through investments. A chart can make destruction feel abstract. A red line moves down. A green line moves up. Oil gains 5%. Defense stocks rise. Airlines fall. But behind those movements are real people. A higher energy price means a family may struggle to heat its home. A damaged shipping route may mean food becomes more expensive. A government contract may represent equipment being sent into a place where people are afraid for their lives. Financial language can remove the human reality from the story. That is why rising markets should never be interpreted as proof that a war is harmless. The market can absorb financial consequences while ignoring costs it cannot calculate. It cannot measure the fear of a child hearing explosions. It cannot measure the value of a destroyed community. It cannot measure years of trauma. It cannot measure the scientific discoveries that never happened because a student was forced to leave school. It cannot measure the businesses that were never created. It cannot measure the lives that would have been lived. Those losses are real, even when they do not appear in a company's earnings report. So when stocks rise during a war, the market is not declaring that the war is good. It may be saying the conflict is smaller than feared. It may be saying certain companies will earn more money. It may be expecting government support. It may be anticipating lower interest rates. It may be reacting to investors who sold too much before the fighting began. It may be looking past the present toward an eventual recovery. Or it may simply be rising because a few giant companies are strong enough to pull the entire index upward. The explanation is rarely just one thing. It is usually a combination of expectations, positioning, government spending, industry differences, interest rates, currency changes, and investor psychology. The strange part is that all of these financial explanations can be rational while the situation itself remains deeply tragic. A market can behave logically according to its own rules and still look completely disconnected from human reality. That is because it was built to answer a narrow question. How much are future corporate profits worth today? It was never built to answer the larger question. What is the true cost of war? The first question can be placed inside a spreadsheet. The second cannot. And that is the real reason stocks can rise while the world appears to be falling apart. Markets do not need conditions to become good. They only need conditions to become less frightening than expected. They do not need suffering to end. They only need investors to believe future profits will survive. They do not need peace to arrive today. They only need people to believe that eventually, tomorrow may be more stable than yesterday. So the next time a war begins and the market moves higher, do not assume investors are celebrating. Do not assume the economy is safe. And do not assume the human consequences are small. The market may simply be revealing how terrified investors were before the conflict began. Stocks are not rising because war is good. They are rising because the future investors imagined may have been even worse.